The American automotive industry is facing one of its most challenging periods since the 2008 financial crisis. Today, we're going to explore 15 car companies that are teetering on the edge of bankruptcy, examining the factors that led to their decline and what this means for the future of American manufacturing. Let's start with Detroit Electric, a company that attempted to revive a century-old brand name in 2008. Despite ambitious plans to produce luxury electric vehicles, the company has struggled to secure consistent funding. Their prototype SP01 electric sports car never made it to mass production, and recent reports indicate they've burned through their last round of investment capital. With mounting debts exceeding $50 million and no clear path to production, Detroit Electric appears to be heading toward Chapter 11 bankruptcy. Karma Automotive, formerly known as Fisker Automotive, has been struggling since its acquisition by Chinese auto parts supplier Lordstown Group in 2014. Despite launching the Rivian GT, sales have been disappointingly low, with only 27 units sold in the last quarter. The company has laid off 60% of its workforce and is reportedly seeking emergency funding to avoid bankruptcy proceedings. Lordstown Motors presents perhaps the most dramatic fall from grace. After going public through a SPAC merger valued at $1.6 billion, the company has faced numerous setbacks. The SEC investigation into misleading statements about pre-orders, coupled with production delays and quality issues, has sent their stock plummeting by 95%. With only $150 million in cash reserves and burning through $50 million per quarter, bankruptcy seems increasingly likely. Next is Faraday Future, once dubbed the Tesla killer. Despite finally delivering their first FF91 vehicles, the company is hemorrhaging money. Their Q3 2024 financial report shows a concerning burn rate of $100 million per quarter, with only $65 million in cash reserves. Their ambitious production targets seem unrealistic given their financial constraints and mounting supplier debts. Mullen Automotive, despite acquiring assets from bankrupt ELMS, has struggled to establish itself. Their promised lineup of electric vehicles has faced numerous delays, and their stock has been delisted from NASDAQ. With only enough cash to operate through mid-2025, they're racing against time to secure additional funding. Local Motors, known for their 3D printed vehicles, has already ceased operations but is attempting a restructuring. Their innovative manufacturing approach couldn't overcome the challenges of scale and profitability. Their assets are currently being liquidated, marking a sad end to a company that tried to revolutionize automotive manufacturing. VIA Motors, focusing on electric commercial vehicles, has seen its market position eroded by larger manufacturers entering the space. Their partnership with Volvo hasn't yielded the expected results, and they're struggling to maintain operations with mounting losses exceeding $200 million. Bollinger Motors has pivoted from consumer vehicles to commercial applications, but this shift might be too late. Their B1 and B2 electric trucks never made it to production, and their commercial vehicle strategy faces intense competition from established players. Their recent layoffs and office closure suggest imminent financial trouble. Canoo, despite securing some high-profile contracts, including with NASA, is burning through cash at an alarming rate. Their unique subscription-based business model hasn't gained traction, and they're struggling to begin production. With only $36.6 million in cash and quarterly expenses of $70 million, their future looks uncertain. Workhorse Group has faced significant setbacks, including losing the USPS contract and recalling their C1000 electric delivery vans. Their stock has plummeted 98% from its peak, and they're struggling to maintain operations with limited revenue streams. Atlas Motor Vehicles, despite promising revolutionary battery technology and electric trucks, filed for Chapter 11 bankruptcy protection in December 2024. Their ambitious claims couldn't translate into viable products, leaving investors and employees in limbo. Lucid Motors, while better capitalized than others on this list, is facing serious challenges. Their production targets have been repeatedly revised downward, and they're burning through cash at an unsustainable rate. Without significant improvements in sales or additional funding from Saudi Arabia's Public Investment Fund, they could face financial distress by late 2025. Rivian, while having significant backing from Amazon and Ford, is not immune to financial pressures. Their production costs remain high, and they're losing money on every vehicle sold. Their cash reserves, while substantial, are depleting faster than expected, raising concerns about long-term viability. Phoenix Motorcars, focusing on medium-duty commercial EVs, has struggled to secure sufficient orders to sustain operations. Their recent quarterly report shows concerning trends in cash flow and order backlog, suggesting potential financial difficulties ahead. Lastly, Nikola Corporation continues to face challenges after their founder's fraud conviction. While they've managed to deliver some hydrogen trucks, their financial position remains precarious. Their hydrogen infrastructure plans require significant capital, and investor confidence remains low. These companies' struggles highlight several common themes in the automotive industry. First, the capital-intensive nature of auto manufacturing makes it extremely difficult for startups to achieve sustainable production scales. Second, the transition to electric vehicles, while necessary, requires massive investments in technology and infrastructure that many companies can't sustain. The impact of these potential bankruptcies extends beyond the companies themselves. Suppliers, dealerships, and thousands of employees could be affected. Moreover, these failures could make investors more cautious about funding new automotive ventures, potentially slowing innovation in the industry. However, it's worth noting that bankruptcy doesn't always mean the end. Companies like General Motors emerge stronger from bankruptcy, and some of these struggling companies might follow a similar path through restructuring. The technology and intellectual property they've developed could also find new life under different ownership. The next 12 to 18 months will be crucial for these companies. Those that can secure additional funding or strategic partnerships might survive, while others will likely join the long list of failed automotive startups. This period of consolidation might ultimately strengthen the industry, but the path there will be painful for many stakeholders. For consumers, these developments raise important considerations about warranty coverage and service support for vehicles from struggling manufacturers. It's a reminder that when purchasing from newer automotive companies, particularly in the electric vehicle space, due diligence about the company's financial health is crucial. The American automotive industry is clearly in a period of transformation, and not all companies will survive this transition. While this might seem concerning, it's worth remembering that periods of disruption often lead to stronger, more innovative industries in the long run. The question isn't just which companies will survive, but how the industry as a whole will emerge from this challenging period.